Okay, I am here with the man, the myth, the legend, Mike Desormeaux, rockstar coach. And I'm just sitting down here with Mike just for a general real estate update on what's going on. Rents, purchase prices, interest rates have just gone up. This is just after the September interest rate increase. So we know that these interest rate increases in the last few months have been having an effect. Just overall, what are the types of trends that you're seeing? What's going on in the market right now, Mike?
Yeah. So as of this date, mid-September, we've seen 5 interest rate hikes. So we've gone from 0.25 to 3.25. And for context, the last time we saw something like this was in 2008 with the global financial crisis. So we're sort of in a similar market now where we're back to much like 2008, where again, we can negotiate on purchase price. We can get our inspection in. We can get our financing clauses in. Because for the past 2 years, you were buying no inspection, no financing, over ask, but we're back again. The nice thing is that we're back to negotiating again, and prices, for buyers have come down anywhere between 10 to 20%, depending on the area. But in the particular market that a lot of our investors lean towards, the data that we're pulling all across Southern Ontario, and coincidentally, Toronto is sort of mirroring this data as well. So on our analytics that we have access to, I'm specifically referring here to townhomes, semis, detaches, not condos for this data, across Southern Ontario. So south to Niagara, west to London, north to Barrie. Mm-hmm. So all around sort of the Golden Horseshoe, going south, west, up north. We're going to go again for our purposes of this conversation, what the majority of investors are buying. So $400,000 plus, 2,500 square feet and lower, and then built prior to 2000. That's a lot of the stuff that we're buying, because with those types of properties, our 1960s, 70s, 1980 builds, we're getting a bungalow with that side or rear entrance where we can turn it into several options: student rental, second suite with a garden suite. Recently we had one 2 days ago that we firmed up in Welland, where we're going to turn that 2-story home into a triplex. You can't do that with new construction.
Why is that? Just the layout?
Yeah, it's a super good question. It's part on the layout, yes. More so, though, that all these municipalities are forced to do high density. So a lot of this stuff can't accommodate that type of option. Like it's, a lot of the builds that we're seeing are back-to-back townhomes, 3-story townhomes. There's no side entrance. There's no back entrance. There's a front door. Mm-hmm. There's a basement, but often that basement is down to like 450, 500 square feet. It's usually small with no separate entrance most often. But a lot of these older homes built on these bigger lots, 50 by 100, you can accommodate those types of options with those types of homes. But yeah, new builds don't offer those luxuries for investors.
Wow, makes sense.
So in regards to listings, I just got to blow up my screen here. Yeah, so new listings, our peak was in May. Mm-hmm. So we had our first interest rate hike in May, but it was only a quarter point. That really didn't do anything to the market. It was in April when we had that half point, then that's when things started to slow down. So in May was our peak. Now what we're seeing for the particular homes that we're going after, the majority of investors that we work with, the listings are starting to slow down. Now that typically doesn't happen until October. So October, November, and then December. Historically, December is when there's the least amount of listings on market, which makes sense, right? It's mm-hmm. Christmas, it's holidays. A lot of people don't want people trekking through their homes while they're home for the holidays. And then it picks right back up into spring. So this decrease in listings has happened prematurely. So we're still about we're about 2 times the amount of listings that we've seen pre-pandemic. But at the height of it, we're down by about 38%. So we're coming down. So there's going to be what it's looking like right now, less properties on market for investors moving into the end of the year.
But 2 times the amount that there was pre-pandemic.
You got it, yeah. Which it sounds like that's a lot of inventory, but that's not. So
because it was already so low.
Exactly, yeah. So we are moving towards about 3.3 months of inventory. which means if no other properties were to come to market, it would take 3.3 months for that inventory to be purchased and off market. That is still historically very low.
Mm-hmm.
So it might sound like there's a lot of stuff on market, but there's not.
Yeah.
Yeah, we're still short on inventory. Days on market though is increasing. So we've gone from pre-pandemic 20, 30 days on market. That's how long it would take on average for a property to sell. Then we moved to a couple days to a couple hours during the pandemic, right?
That's wild.
Yeah. And then in April, these days on market increased again. So we're seeing on average again for these specific types of properties, 20 to 30 days on market. So they're on market a little longer. Houses currently for sale. So of those types of properties that are on market, how many are still for sale? So again, moving all the way up until April was our peak. And then the interest rate hikes start happening. And now we're seeing, as of late August, so this is when the trend slowed down. We're seeing less of these homes on market now, like currently for sale. Mm-hmm. So we have less listings coming to market. And then those that are presently on market, there's less of them staying on market now for various reasons. Some are being purchased. And then others are sellers that are just like, you know what, I'm not getting the price that I wanted. Therefore, I'm going to take my property off market and maybe wait to see if the market gets any better and they can get a higher price for their property. So those two are the catalysts of why there's less properties on market. Like they're coming off, the inventory's coming out. In regards to properties and what they're selling for, properties were selling for about 130% of the original price. So now we're seeing that come down to about 95%. So 130% of the original price. There was a bit
of the asking price?
Of the asking price, yeah. There was a little bit of manipulation there because the agents, what they were doing is, so 100% would be the property is listed for $1 million, it sells for $1 million. Mm-hmm. And if it shows above that, then depending on the percentage above, there was some manipulation happening there. And that was agents were listing properties, and sellers had a voice in this as well, where they knew their house would sell for, let's say, north of just $1 million. But you know what? Let's see what the market will pay. It sounds like a few years. It was a few months ago, right? Mm-hmm. It was the beginning of the year when it was absolute chaos. So listing agents and sellers collectively would say, okay, well, let's see what the market will pay. So I know my house is worth $1 million. Let's list it for $899. Hold offers. Let's review offers in 5 days. And then you get these bidding wars, and that's how you're getting such a high percentage over ask. So a bit of manipulation there. However, the majority of the properties on market now, they're back to a more realistic list price. So of what the market's willing to bear for that particular home. So of these new prices, we're seeing about a sale price of 95% on average of the original list price.
Do you take that into account in your offer strategy when you're helping people? The average is 95, so you'll come in at around the same.
Yeah, I think, no, we won't come in at the same. We may end up at the 95 percentile of the original list price, but we're probably coming in lower. We might come in at 75%.
Yeah, like you're just, that low. Okay.
Yeah. I have a saying right now that I'm sure you've heard, and I'm telling people, if you offer and you are not embarrassed by your offer, you've offered too much money.
Yeah.
It's just, as buyers, it's a good time to take advantage of this opportunity. We haven't had this luxury in many, many years. Mm-hmm. So it would be different if you really need this house for your family, but as an investor buying an investment property, take advantage of the market right now, this unique time.
Yeah, you've got a little bit more control.
As buyers, yes, all buyers across the board absolutely do 100%. Yeah. And then in regards to sales price, again, we're down on these particular properties about 10 to 15%. However, what we are seeing now is it's sort of leveling out. Now, this data, the analytics that we have are all the way up to the end of August, so 2 weeks ago. Mm-hmm. So September, we had that last rate hike of 3/4 point. So I guess we're going to have to see over the next few weeks what that's going to lead to in regards to sale prices. But the analytics show, so it's a combination of, we have new listings are down. We have days on market, 20, 30 days on average. We have active listings flatlining and declining. And then we have the average sale price down and flatlining. And then sales are up. So it's the indicators are showing for now that it looks like we're sort of like coming in for a smooth landing. But, we don't have the data from the most recent interest rate hike. Mm-hmm. So it'll be interesting to see what happens over the next few weeks and into, the colder months. But right now it sort of looks like we're coming in for a soft landing. And then the Toronto data is showing the exact same thing that we've been talking about here about sort of the 905 around the GTA.
If anyone you're talking to is trying to time this and time the bottom, what are you telling them? What's the conversation?
Yeah, it's impossible, but everything literally is on sale from the beginning of the year. So I think a lot of this inventory is being now purchased, because imagine you were a family that was renting and it was you were looking for, let's say, the last 2 years. Affordability for a lot of these people, they got priced out of the market. Mm-hmm. Now, taking into consideration, yes, interest rates are going up, but a lot of these, a lot of the properties in different communities, the prices have come down. So have they now qualified to be able to finally purchase again? And if I have a family and I got to get a roof over my head, the last thing you want to do is let this train leave the station and not be able to, this is your one time opportunity to get a roof over your family's head. Like, how long do you wait?
Yeah.
So in regards to timing as an investor, as long as you're going in long term, I'll finish off with some key points of probably what most people should be doing nowadays. But as long as you're going in long term, the data that we're seeing, and if you're going to go in aggressive with your offer, therefore getting it below even the current average sale price, why not? You're making a little buffer there for yourself as well. Because the fundamentals of all of this are still the same.
Yeah. So
lack of a developable land. I have data that we shared at the recent VIP event where at a record pace, we're building 75,000 homes per year. And the household formations, though, are much greater than that. So the data was 2016 to 2021, we needed a little over 413,000 homes. We built 349,000 homes. So we were short 65,000 homes. Over the next 5 years, there's going to be 489,000 household formations in Ontario. So even if we go at a record pace from 2021 to 2026, we're already at the end of 2022 almost. If somehow we're going to go at a record pace and build another 349,000 homes, which we're not, we see it on the streets, builders canceling projects. There's still supply chain issues, material costs. We're not going to be building at this record pace. But if we build another 349,000 homes when 421,000 are required, we're short another 72,000. Then the next 5 years, we have another dilemma, and that is household formations. So from 2016 to 2021, household formations, how many houses we need to accommodate families, not for affordability. This is just, we need housing for these families, was 413,000. At a record pace, we build 75,000 a year. From 2016 to 2021, we built 349,039 homes. So we were short 64,000 homes. From 2021 to 2026, household formations are projected to be 489,000. If we build at a record pace, 349,000 homes again over the next 5 years, we're already at the end of 2022. We see there's supply chain issues, builders canceling projects, costs are going up for trades and materials. I doubt we're going to be building at a record pace. But if we do, we're short, building at a record pace, 140,000 homes for that year. For 2026 to 2031, the following 5 years, we're required to build 421,000 homes. If we build at a record pace again for those 5 years, we're at 349,000 homes. We're short 72,000 homes. For context, over the next 9 years total, we will be short 277,000 homes, just over.
This is all of Ontario or Southern Ontario?
All of Ontario.
Yeah.
So And then for greater context, Mississauga, households in Mississauga, including condos, there's 195,180. So we need a Mississauga, we need a Barrie that has over 52,000 homes, and we need a Milton, over 34,000 homes.
Wow.
So over the next 9 years, the amount of households that we need would be a Mississauga, a Barrie, and a Milton, with the population that we have coming in. Like, it's not going to happen.
Yeah.
9 years is going to come like that. Yeah. And then just a lot of the housing that is being built is not this single family stuff that we're talking about that we invest in. So when you or I are investors, the average person that buys a home, the average family, they're probably moving in 5 to 10 years. They're going to upsize, they're going to downsize, circumstances may change. When an investor buys a property, they've taken that inventory off the shelf, and it's not coming back onto that shelf for decades, usually, because the investor is going to hold on to it 10, 20, 30 years, potentially then pass it down to their children.
Mm-hmm.
So it's not coming back to market. So as investors are buying properties, specifically what we're talking about, where you can add second suites and et cetera, there's less of those types of properties are not being built, first of all. So there's just less and less of those opportunities out there. I mean, there's still lots of it out there, but I mean, it doesn't come back to market for quite some time.
Mm-hmm. Yeah, those are the types of homes we were talking about at the beginning, where it's pre-2000s, $400,000 up.
Yeah.
Big lots.
You got it.
Yeah, 60s, 70s style bungalows.
You got it. Side splits, back splits. Yeah, you got it. And then in regards to rentals, so there was this huge exodus out of Toronto during the pandemic. And then we've seen, because we've been trying to help some people get into some leases in Toronto, and it started in June. And we started submitting offers, and that's when prior to June, we wouldn't have multiple offers. But then come June, people coming back to work, students coming back to university, it all started then where things were going into multiple offers again. So we've seen where we're going up against 2 other offers, 10 other offers. But so the Toronto rental market is picking up once again.
Mm.
And that is forcing rental prices to rebound. So during the pandemic, the Toronto condo market, the rental prices went down for obvious reasons. There was this huge exodus out of Toronto. Airbnbs got shut down. And now with the wave back, with people coming back to work and into school, we're higher in rent pre-pandemic.
Wow.
And then the 905s for single family homes, properties that we're, as investors are buying for, 700,000, 750,000, 18 months ago, these are properties that were probably renting for about $2,200, $2,300. Now they're renting for $3,000 on average. So rent prices are up all across Southern Ontario. And that, I don't think it's going to continue to go up as aggressively as it has, but it has gone up aggressively. And that it's unfortunate because as investors' costs rise, unfortunately it gets passed down to the tenants.
Mm-hmm.
Like somebody's got to make up for it.
Yeah, this is a housing crisis. This is
yeah.
I mean, the writing's on the wall. If you're an investor, you know what you got to do if you want to buy a rental property, make some money. It's quite simple.
Yeah.
But yeah, it's not good. I don't for like
No.
society.
Yeah, it's the cards we're dealt though, right?
Yeah.
You have to deal with it.
Yeah.
So if an investor is buying, it's the right time to haggle on price.
Mm-hmm.
It's the time to get your home inspection in, your financing clause in.
Be embarrassed by your offer.
Be embarrassed by that's key. If you're gonna take away anything from this, if you're not embarrassed from your offer, you haven't offered. Sorry, you've offered too much.
Yeah,
you got to get embarrassed. You got to get flesh faced. So are we at the bottom for the specific types of properties that we're looking at? The indicators potentially are showing that if we're not there, we're potentially close. But again, we don't have the data for September.
Mm-hmm. Mm-hmm.
But it's like supply and demand though. With inventory coming off market, it's going to put pressure for the current prices to remain relatively close to where they are, I think.
Mm-hmm.
But we'll see.
Yeah.
We'll have another one in maybe September of October and with an update. So if you have to sell, don't sell if you don't have to, because you're not going to get top dollar. We're not the only ones out there, trying to haggle on price. First time home buyers are doing the exact same thing. It's their only opportunity to have done this in several years. Avoid short-term flipping.
Yeah.
Again, the market's, it's too volatile right now. Long term, we'll be okay. Anything short term, it's a little risky right now. Keep into consideration too, as investors, prices are down, but rents are up. So it's sort of offsetting the fact that we have higher interest rates with our rent prices coming up. If you're buying, buy aggressively. Best homes to look for are homes that have multiple opportunities: second suites, triplexes, garden suites. And get your home inspection and financing clauses back in. That's important.
Yeah, exciting times. Yeah, good time to be an investor.
Yeah, it is. It absolutely is. Yeah, and it just goes to show, like, yes, prices have come down, and because you asked about timing the market, it's absolutely impossible to time. Like, it never. Looking back, you can make sense of this, but looking forward, nobody knows. And if somebody thinks they know, they don't know. But what other asset class? Because everything has come down. Stocks, crypto, everything has predominantly come down. But what other asset can you invest in where when it does come down, like, you have a few properties yourself, Anthony. The tenants are paying down the debt. So if let's say your property flatlines, so whatever you bought it for, it flatlines for the next 25 years. You're young. The house will be paid off in 25 years. You still made significant return on your investment.
Yeah.
There's no other investment opportunity we have like that. If you invested in, I don't know, Coca-Cola, and Coca-Cola flatlines for the next 25 years, well, whatever you've invested in, you're going to potentially, if you take that out, it's not like you broke even. Because of inflation, you're significantly down.
Yeah. Maybe you got a dividend, but inflation's wiping that out. And
yeah. The sort of when I was looking for a calculator to calculate inflation, one of the first sites that I stumbled upon was the Bank of Canada's website. And it was, I'll try to find it now very quickly. The Bank of Canada, it was like, when you see a magician and they do a trick and you're like impressed. It's like, wow, that was a cool trick. But then they show you how to do that trick, and then it's not so impressive anymore. Right?
Yeah.
The Bank of Canada's own website. Anybody can go to this site, bankofcanada.ca. There's a inflation calculator. And they use their baskets of goods, and we know that those basket of goods are not so realistic. But they have in there the average annual rate of inflation percentage. And so there's a calculator there for you. So in brackets, they have also the decline in the value of money. That's the only thing that they're like just sort of reiterating, like clarifying for you. It's like, hey, here's our annual rate of inflation percentage. We're also saying it's the decline in the value of money.
They specifically call it out.
Yeah. Right to us, right under our own nose.
Yeah.
Like
it's weird that they put that on the website, but then that doesn't seem to be the messaging you get.
Exactly.
When
100%.
They're talking about flushing money into the system and keeping rates low. It's like they don't ever call out it's the decline in the value of your money.
Yeah. So why be a saver? How can you win here if you're just trying to save some money? They're calling it out. We have a target, and this is the target of the decline of your money.
Wow. Yeah. They're telling you what they're doing.
Yeah.
Okay, cool. Anything else you want to share on the market, Mike?
I think that's it. Just get ready to be embarrassed.
Yeah.
For once in our life, being embarrassed is a good thing.
Yeah. I want to get embarrassed.
Yeah, there we go.
Cool, man. Okay.
Awesome.
Thanks, Mike.
Cool.